Welcome to the Moments That Matter podcast. I am your host, Laura Escamilla.
And I am your co-host, Isaac Escamilla.
So last episode, we talked about tuition assistance programs in Texas, what they actually covered. We talked about how they can significantly reduce the cost of college, but not eliminate it entirely. Housing, meals, transportation, books, these pieces remain. So today, what we're going to do is we're moving into the topic that fills the gap for many families: student loans and Parent Plus loans. And I want to be upfront about something. This is a topic that many families avoid discussing early. It feels uncomfortable. It feels like a planning failure if you have to use them. But I have found the opposite to be true. Families who understand how loans work before they need them make very different decisions that families who encounter them for the first time inside a financial aid office in the spring of their student senior year. So this episode is not about judgment at all. This is information, because loans are not inherently bad. They're just often misunderstood, and misunderstandings, especially with loans, can create consequences that will last well beyond your child's graduation. So let me start with something I've observed consistently in my research, conversations with families. Most families do not begin the college process planning to borrow large amounts of money. Borrowing tends to happen gradually. It happens when a gap appears between what the financial aid offer covers and what the school actually costs. And we get this. We borrowed. We took out Parent Plus loans for our kids, for both of our kids. So we get it. This is not, again, judgment. This is just what happens. It happens when an offer to a school feels like close enough. It happens when families think we'll figure it out later, and later happens very quickly. So understanding how federal student loans and Parent Plus loans work before those offers arrive can give families the language and the framework to ask the right questions instead of just signing and filling out a form and not really understanding what's going to happen. So let's start with federal student loans, the ones in the student's name. And before we talk about amounts, I want to make sure families understand that not all federal student loans work the same. There's two types, and the difference between them has real financial consequences. So the first is a direct subsidized loan. This is the better of the two. It's need-based, meaning your family's financial situation, as determined by FAFSA, qualifies your student for it. So there's that word again, FAFSA. And here's the key benefit. The federal government pays the interest on this loan while your student is enrolled at least half time. That means that the loan does not grow while your student is in school. When they graduate, they owe what they borrowed and no more. The second is a direct unsubsidized loan. This one is not based on financial need. Most students qualify for some amount regardless of income. But here's the critical difference. Interest starts to accrue the day the money is dispersed, the day it hits the account. Even if the student is sitting in their freshman orientation, even if repayment is years away, now students have a choice. They can pay the interest while they're in school. Even small monthly payments can make a real difference on that interest if they're paying. Or they can let it accumulate. And when repayment begins, that unpaid interest gets added to the loan balance. Then interest starts accumulating on a larger number. So if your student receives subsidized loans and they're offered them, take every dollar offered, because subsidized loans, you're going to start paying back just what you borrowed when you graduate. Subsidized loans are always offered first, and a student cannot hold them and save them for later. So if they're offered to you, you need to take them when they're offered, essentially.
Okay, take it.
Yeah, you can't go back later and decide once you decline them that you can go back and take them. So when subsidized eligibility runs out, also, that's when the unsub funds kick in, because there's only a certain amount of subsidized funds available.
Correct.
So if you decline them, they run out. The only option left is unsub. So understanding that order helps families make smarter decisions about how much to actually borrow. So here's what most parents don't realize. The federal government caps how much a student can borrow each year. And those limits are actually pretty modest. I talk about this in the workshop and explain, compared to when we went to college, that we could just go into a financial aid office and fill out a form and they gave us what we needed. We borrowed. That's why our generation has student loan debt.
A very high amount
A very
of
high
student
amount.
loan debt.
Yeah. So currently, a freshman can borrow up to $5,500 total. A sophomore up to $6,500. Juniors and seniors up to $7,500. And over an entire undergraduate career, the lifetime cap for dependent students is $31,000. So when you look at what 4 years of college actually costs, even at a Texas state university, $31,000 in federal student loans won't come close to covering a full bill. So
Not a full 4 years.
right, not the full 4 years. So there's one more thing that families need to know about these loans. There's also an origination fee. So every federal loan has a small fee deducted before the money is dispersed, roughly about 1% of the student loans. So if your student is offered $5,500, the actual amount that will arrive to the student is slightly less because of that fee. But you still have to pay back the full $5,500. They're just taking like a processing fee to do that. So it's a small number, but it's worth knowing so families aren't surprised when they don't get that full $5,500
I didn't know
dispersed.
that. I just learned that just now.
Yeah. So we've always paid an origination fee for these loans. So if we borrow $5,500, it won't come out to that. So we can't depend on exactly that amount.
Okay.
These limits and structures exist for a reason. They reflect what policymakers believe a student can reasonably repay when a student loan runs out. And for many families, they will. That's when families typically look at Parent Plus loans to fill the remaining gap. So this is where we're going to go a little slower because Parent Plus loans work very differently from student loans. And the differences matter enormously. A Parent Plus loan is a federal loan. You are, again, going to go through FAFSA. You're going to fill out a separate application for it later on after you've done your normal FAFSA application. But it is issued to the parent and not the student. The parent is solely responsible for repayment. The debt cannot be transferred to the student. And I need to say this again. The parent owns the debt. It does not belong to the student, and it can't be shifted to the student later. Unlike student loans, which require a credit check for eligibility in a limited way, Parent Plus loans do require a credit check, and that check looks at credit history. A parent with adverse credit history may be denied. Here's what surprises many families. Passing the credit check doesn't mean that the loan is affordable, right? It means the parent isn't disqualified from it. So, and the origination fee for Parent Plus loans is significantly higher than the regular student loans. Over 4%. So on a $10,000 Parent Plus loan, a parent receives closer to $9,570, but they're still going to owe the $10,000. And that is just the origination fee. You know, they still have interest and things to consider. So for families borrowing larger amounts, that gap can add up. So until recently, there was no cap on how much a parent could borrow through the Parent Plus loan program. Parents could borrow up to the full remaining cost of attendance after all other aid was applied, every dollar to fill the gap for all 4 years. And many families did that without fully understanding what they were committing to. And we did that, but we understood going in what we were expecting at the end.
Yes.
And the thing is that this policy is changing, and it's changing very soon. So in July 2025, Congress passed new legislation, which you may have heard it referred to as the One Big Beautiful Bill. And it includes significant changes to Parent Plus loans that take effect July 1st, 2026. So this year, just months away. So starting the next school year, Parent Plus loans will be capped at $20,000 per student per year, with a lifetime limit of $65,000 per student. For families whose costs exceed that, and at many four-year universities they do, this is a significant change. So it means that the gap that Plus loans used to fill entirely are only going to be partially filled going forward. So now here is the part that is time sensitive. And I mean, genuinely urgent for some families listening to this episode. If a parent borrowed a Parent Plus loan for their student before July 1st of 2026, they can continue to borrow under the old unlimited rules for 3 more years, or until the student completes the program, whichever one comes first. So that is called the grandfathering provision. So if your student is currently a freshman, sophomore in college, and you've already taken out a Parent Plus loan, you may already be protected under those older rules. Of course, talk to your financial aid office to confirm your specific situation. But if your child is in high school, they're freshman, sophomore, junior, meaning they won't be entering college in fall 26 or later, they will be subject to the new caps from day one. So if you anticipated using these plus loans heavily to cover college costs, that plan needs to be revisited right now. So my strongest recommendation is do not try to navigate this on your own. Consult with financial aid and an advisor who is currently aware of these changes, because the higher institutions have this information and they're continually getting reports and updated information and training to be able to help families. So make sure you're going to a financial aid office to understand these things.
Yes, the financial aid office at the university or college or
they're looking at.
They do keep up with all the
right,
rules
and they have to do trainings
Yes.
as information changes or rules change. So the rules are new. Implementation guidance is still being finalized, and the stakes are high enough that this is not a moment for guesswork. So you want to make sure you understand and you know what's happening. So whether you're looking at the old rules or the new ones, there are things about Parent Plus loans that remain true and that families still need to understand. Parent Plus loans carry higher interest rates than undergraduate federal student loans. And unlike subsidized loans, interest on Parent Plus loans begin accruing immediately from the day the money is dispersed, just like the unsub loans. So repayment can often be deferred while the student is enrolled, but the balance keeps growing during that time. Whether you choose to start paying on them immediately or not, the interest is accruing. So I've had parents genuinely surprised with the amount that comes up at the end of those 4 years.
Sure.
And I'm not going to lie, we were too with our first child when we got the total after the end of the 4 years. It just seemed very easy to take what we needed and we would figure it out.
Right.
So we were more conscious about it
The second time around.
Yeah.
Definitely.
And we worked harder at ensuring that our son got more merit aid at the university so that we would be borrowing less, and we made more conscious efforts the second time around.
We definitely borrowed less.
Yeah. So you can't assume because you don't have to make the payment until later that the interest isn't accruing. So all that means is that your monthly payment can wait to be paid until after graduation, but the interest is not, and it's still there. So when we're thinking across 4 years, borrowing $20,000 in a year might feel manageable for many families. Borrowing that amount or near it 4 years in a row is a different conversation, though. The total at graduation is the number that we should be thinking about when we're making our decisions about school. What are we going to owe at the end of this journey?
Correct.
And we're assuming 4 years, but some programs could be 5 years. Or if your student is not on top of their grades, their class schedules, and, following their plan, their academic plan, and they go into 4.5 years or 5 years, that costs money. That's going to keep costing you money. So you have to have those conversations and make sure that they're doing it correctly.
Right. There's a lot of reasons why you would take a little bit longer than
for sure
you planned.
Yeah. I mean, it's easy just to go, I need one more class and,
I understand. It happened to me.
Yeah. Well, we're not talking about 10 years. We're talking about one extra year.
Sure.
I want to give a framework for thinking about borrowing that I use in my workshops because I think it makes the long-term picture more concrete. So a useful rule of thumb is that total student debt at graduation should not exceed the student's anticipated salary their first year in a chosen field. So we use the example, if your student is going to be an engineer, typically their starting salary is about $100,000. That is a good number to work with. But if your student's going to be a teacher, that is
closer to 50 or 60.
Right. So you want to make sure that if a student graduates with $20,000 in loans and enters the field paying $40,000 a year or more, that payment is roughly $220 a month, and that's manageable. So if they graduate $31,000 in loans and earn $50,000, that might work too. But as you can see, the more this goes up, the higher the payment, and you can start to get yourself in a situation. And even as the parents in our situation, we worry about that too. So this is really a conversation that you have to think about how it's going to cause a strain financially later when you have to start making these payments. So with both the student loans and the Parent Plus loans, you can defer payment until graduation. So you also have to think about, again, we've talked about the interest, but think about what if your child doesn't finish school, then you have to immediately start paying those loans. So you have to have this big picture in mind. When you're thinking about the Parent Plus loans and you start thinking about a larger dollar amount too, you have to think your family's going to start paying this, and it's in addition to mortgages, right? And retirement contributions and these family expenses that we have.
Right. The business of living.
Right. So we really want to encourage families to ask, not just can we borrow this, but if we borrow this, what is it going to look like in 4 years? What is that repayment going to look like? And can we handle that with what we're already doing? Right. So these are questions that you and I have had many times, thinking about what our payment's going to be, how we're going to navigate that. Here's something that comes up repeatedly in conversations and in my research as I was having conversations with students. And it's why we're doing the podcast, right? To share this information that I've come across and I feel people need to know. So middle income families often find themselves in a difficult position. They don't qualify for significant need-based grants, and they don't feel financially in a position to just write a check to the school. So loans become the bridge, but often without a clear-eyed conversation about what that bridge costs to get to the other side. The families in my research really are feeling unprepared for making these decisions. And they're not necessarily parents or families with the most money. And I have friends or other parents that we've talked to also that had to borrow, and they make more money than we do, right? So there's not a clear indication that if you're in this level, you're going to need loans. People need to borrow for all kinds of reasons. Everybody's financial situation is different, and we can't assume it.
That's exactly what I was going to say. Everybody's situation is different.
Yeah, we don't know what people have to pay. If they're helping other family members, you can't just assume because someone is at a certain income level that they wouldn't need to borrow. Many different financial levels borrow. So when you're projecting the numbers to borrow, we want to make intentional choices about the debt for your family, and if you can add this expense in the 4 years. So again, I'm not trying to discourage borrowing because it's necessary in a lot of cases, but we want to make it intentional. We want to know going in what we're going to borrow, how much we can borrow. So now I want to briefly mention something that often comes up once families realize now that Parent Plus loans are going to get capped and they may not have enough to cover everything that they need. What do they do? And when we did the workshop, that's the question after, what else is there? So private loans through banks and other lenders are really the other option. So private loans are a real option when Parent Plus loan takes effect in 26. So more families are going to have to be looking at them. But before you go that route, there's a few things to understand. First, and this surprises many families, your student cannot borrow a private loan on their own. Unlike federal student loans, which are available to students based on enrollment and FAFSA eligibility, private lenders will require creditworthiness. So for an 18-year-old who doesn't have credit history or the income to qualify, that means that a parent or another creditworthy adult will almost always need to cosign. So when you cosign, you're equally responsible for that debt. So if the student doesn't pay it, you need to pay it. Also to remember that private loans are not subject to the same consumer protections as federal loans. And this is worth thinking about greatly because it connects to something that I want to make sure every family understands about Parent Plus loans before they compare them to private loans. Parent Plus loans, for all of the paperwork complexity and the rules on them, do come with some meaningful safety nets that private loans do not have. So if your family hits a financial hardship, job loss, medical crisis, unexpected life event, Parent Plus loans offer options. They have deferments. You can temporarily pause payments if you're facing hardship or if your student is still enrolled in college. Forbearance gives a little bit of room when you're struggling and you need just like a month here or there to pause payments. And there's also income-driven repayment plans. While they're more limited for Parent Plus loans, they do exist and can help families manage something that's affordable, a payment that's affordable for them. And there's also forgiveness programs available to parents who work and qualify in public service roles.
Yes.
So these are not guaranteed things for sure, but they're options in Parent Plus loans, options that private lenders do not offer. So you want to consider that if you're in a situation where you don't know if you have the option just between a Parent Plus or a private loan. In some cases, as we discussed just a bit ago, you might have to do both. But if you have an option, make sure you're considering not just interest rates, but these safety nets. So private lenders will set their own terms, and those terms will vary widely from one lender to the next. Some private loans have variable interest rates, which means your repayment can change over time, and most offer fewer safety nets than these federal loans would. And we have an example of that during COVID, right? Like obviously a global event none of us expected, and they paused repayments during that time, which was super helpful for people in this situation who may have lost jobs or had to take less hours and work from home and things like that and other expenses. So that did not happen for the private lenders. You had to still keep making those payments. So you want to consider that. Obviously, we don't want another global pandemic, right? But
hopefully not.
So that said, depending on the family's credit profile, some private loans may actually offer a lower interest rate than Parent Plus loans. Parent Plus loans currently carry a rate of 9%. So it's not that private loans are always worse. It's just that you can't assume that they're better without making those comparisons for yourself. So here's what I recommend. If you're exploring private loans as part of your college financing plan, sit down and compare 3 things side by side: the interest rate, the repayment options, and what happens if you need flexibility later. Then compare those answers to what the Parent Plus loan offers and make the decision with all the information, not just default to one or the other based on an interest rate. You want to look at the whole picture. And if possible, exhaust all federal loan options first. So federal student loans for the student, because their rates are lower, than the parent if needed. Then private loans as a last resort. That's generally the order of priority most financial aid professionals recommend to students. So federal loans have more protection, more flexibility. The students' loans are lower interest rates, and they could have some subsidized loans with the interest not being accrued while they're in school. So they're a little more predictable, and you want to make sure that you have all the information when you're looking through this.
Absolutely. So that's another spreadsheet for somebody to
yeah, that's a whole other thing, right? And it's not necessarily school by school right now. You're looking at a whole different component there.
That's right.
So here's the big picture that I want everybody to understand is that loans should not be the first strategy for families. They should be the last tool evaluated within a larger plan. So if a family understands the cost of attendance, FAFSA calculations, tuition assistance programs, institutional scholarships early, the gap that loans need to fill may look very different. So that matters. And the earlier families start thinking through it, the more options they have. So in the next episode, we're going to talk about scholarships. You want to consider the scholarships that are offered by the school, if it's included in this financial aid information, other scholarships to look for, and how to start breaking down that aspect. Now that we understand what FAFSA is, you understand the cost of attendance, you understand your options for everything else. Now we have to start looking for other funds. So that's what we're going to talk about next. And we want to make sure that we have a full picture when we're planning our financial picture for college. So what you should take from this episode is that federal student loans are structured, they're capped, they're offered in 2 forms, subsidized and unsubsidized, and that matters. Parent Plus loans have historically been unlimited, but as of July 26, that is no longer going to be the case. And families need to understand how that's going to affect them. And they need to meet with a financial aid advisor if it's going to affect them.
Strongly recommend that.
Right. And understanding how all these tools work together and what they cost from day one to graduation, big financial long-term picture for your family. Those are conversations we need to have now. And we need to start creating our options and figuring out our path now. So with that said, we will see you next week when we talk about scholarships.
All right. Thanks for listening. Again, if you're listening on YouTube or watching on YouTube, don't forget to like and subscribe. And thank you.
We'll see you.